Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, almost 5 years ago, the Indian telecom sector witnessed tectonic shifts. Reliance Jio, a disruptor with deep pockets, entered the industry in 2016-17, causing a huge value migration from low speed to high speed data. While this evolution was inevitable, with aggressive pricing, the entry of Jio accelerated it, reducing the transition from a typical 10 long year period to just 2 to 3 years. The transition was also helped by the ecosystem, penetration of smartphones, and digital content. In fact, it would not be wrong to say that both the trends fed on each other in a symbiotic and a growing relationship. The result, even as the industry grew, the incumbents and legacy telecom players were adversely impacted. From over 10 players, the industry shrunk to mainly 3. Now, another sector is witnessing its geo moment. It's none other than Indian energy sector. So in this video, I am going to share the names of 3 lesser known stocks that could benefit from this disruption. But first, a few words about this. The Indian energy industry is aspiring to change color from brown, grey and black to green, moving from conventional sources to green and clean energy. From two-wheelers, electric vehicles to e-auto rickshaws, e-buses, solar lighting in institutional and private compounds, and companies minting millions on carbon credits, trading, the wave of transition is quite tangible and no more limited to government policy statements and targets. The latest development on the green energy policy lays a roadmap for hydrogen production until 2030 under National Green Hydrogen Mission. It suggests supplying green hydrogen and green ammonia at the lowest prices in the world. It also shares the ambition to be the key exporter of the commodity. In fact, EU members, Japan, and South Korea have expressed interest in sourcing green hydrogen and green ammonia supplies from India. With an outlay of Rs 175 billion, incentives including PLI schemes are to be rolled out for producing electrolyzers within India. You see, electrolyzers are used to separate hydrogen and oxygen molecules in water to produce hydrogen. By 2025-26, as these electrolyzing capacities come up, huge import duties are proposed for imported electrolyzers. That is the norm now. The initial target is to produce 15 gigawatts and it is expected to grow to 60 gigawatts or more, thus making India the largest manufacturing hub in the world. In short, the policy, ecosystem, and investors with deep pockets have come in together to bring about once in a century disruption in the energy sector. While the policies are focused on making India energy independent, with ESG gaining favor, huge investments are flowing in the green energy theme. As per Bank of America, India is expected to attract $10 billion or 600 billion rupees investment in FDI in this year alone in areas like EV and green hydrogen. The theme has found patrons like Mr. Ambani, Mr. Adani, and Tata Group. Mr. Ambani has unveiled plans to invest $75 billion in clean energy products over 1.5 decades. In 20 years, his target for green energy export from India is $500 billion. Mr. Adani's vision is to become the world's largest solar power company by 2025 and largest renewable power company by 2030. Tata Group too is eyeing five-fold increase in green energy capacity by the end of the decade. And L&T has announced plans to invest up to $2.5 billion in next 3 to 4 years to start with across green hydrogen, solar, and wind projects. And then there is a bunch of companies such as Oil India, NTPC, GAIL, and ONGC that have rushed to join the clean and green energy theme. These ambitions and aspirations will require huge investments, perhaps borrowed capital, and only time will tell whether the return on this investment will be viable. History has enough examples that huge expansions in sunrise sectors have not paid off too well. So while I'm excited about this theme, it is not the big companies making huge investments and headlines that I am keen on. I'm more focused on stocks which are likely to ride clean energy and green energy drive without the downsides or the potential risk of bad investment that these big names may have. These are some lesser known companies that could benefit from the green energy drive and that deserve to be on your watch list. So moving on to the stock names, the first is Bharat Electronics Limited, a well-known defense electronics player that also has JV business that caters to medical electronics industry. The mix of defense and non-defense in the business stands at 80 to 20. So what is this defense stock doing in the clean energy stock watch list? Well, that's because Bharat Electronics has signed a Memorandum of Understanding or MOU with US-based Triton Electric Vehicle to manufacture hydrogen fuel cells. This will involve technology transfer from the latter to meet the requirements of the Indian market. The MOU also focuses on applications such as e-mobility. In fact, Bharat Electronics would be supplying lithium-ion battery packs to Triton EV in next 2 years for its semi-truck project in India worth rupees 81 billion. Bharat Electronics is a PSU, but don't let the tech put you off. Bharat Electronics is unlike its other PSU peers that reek of poor management and execution. Its FY22 return on equity and return on capital employed stand at 21% and 27% respectively, and the long-term return ratios too have been in healthy double digits. The business is debt-free, the 5-year average dividend payout is 41%, and in the last 6 years, the operating profit has grown at a CAGR of 13% from 17 to FY22, and operating profit margins have been about 20%. The cash flow from operations have exceeded the net profits, which is a good sign. The stock is trading at a PE of 27 times. The second is EKI Energy with brand name EKI International. This company works in the realm of climate change, carbon credit, and sustainability solutions across the globe. Unlike the big names that are investing billions and are likely to be under huge debt to unleash the green revolution, EKI Energy is net debt free. It is engaged in carbon credit trading at a global level, with Europe and America accounting for 83%. A carbon credit is a tradable certificate which allows its holder a right to emit over a certain period carbon dioxide or other greenhouse gases. One carbon credit is equal to 1 ton of carbon dioxide. The concept behind carbon credits is that as the price of credits rises, it puts increasing pressure on entities to make permanent reductions in-house so that there is no longer a need for them to purchase them from outside. Coming to the business details of EKI Energy, it offers carbon sustainability advisory services to a wide range of projects such as biomethanation, renewable power, waste management, energy efficiency, and water purification, along with advisory services for the eligible carbon credits. It migrated to BSE main board from SME board in 2022, and its clients include Siemens, Shell Singapore, IMF, Adani, Zomato, Aditya Birla Group, and so on, along with PSU clients such as ONGC, NTPC, HPCL, and IOCL. With 137 countries across the world committing to net zero emissions by 2050, the opportunity size is huge. The demand for carbon credits is expected to increase by 15 times by the end of 2030. The company has more than 1,000 carbon credit projects in the portfolio, including some in green hydrogen, solar, wind, and hydro energy and waste management projects. The company is set to become the first to generate international plastic credits for collecting and recycling plastic waste in the country. Under this, for every ton of plastic collected and recycled, the company earns 2 plastic credits. Plastic credits aim to reduce plastic waste. This is an optionality over and above the carbon credit market. It has partnered with Singapore-based Impact Climate Asset Management Pte Limited to contribute rupees 200 crores towards a 1,000 crore climate impact fund to develop greenhouse gases mitigation projects. The company is also driving smart city mission projects and has been onboarded by Varanasi Smart City. The stock trades at a single-digit PE of 7.3 times and enjoys ROE and return on capital employed of over 100% respectively. If this looks too good to be true, that's because it might be. There are risks in this business. The key risk first is the volatility of the prices of the carbon credit. For instance, in Europe, the prices witnessed a decline from €30 to €5 between 2008 to 2012. The Indian government is planning to address this through stabilization fund to have a minimum floor price for these credits to boost the carbon trading market and cut emissions. There is also a talk of national carbon market that may help with the price discovery and demand. The second risk is the credibility of these carbon credits on whether they really offset global warming. These credits need validation and approval from top independent verification bodies, and not all carbon credits may make the cut. The third is policy-related risk. EKI Energy's stock price took a big knock on announcement of carbon credit export ban until India's commitment of reduction of 45% emission intensity of GDP is met. However, as per the management, while the policies intend to deepen and flourish the carbon trading market within India, it does not impact the voluntary carbon market. All in all, EKI International is at a point of great opportunity along with great risk, and it makes sense to keep it in the watch list. The third company on this list belongs to construction industry, Bigbloc Construction Limited, that manufactures AAC blocks or aerated autoclaves concrete blocks, which is a better quality substitute of red bricks in construction. In the last few years, AC has been replacing bricks for two key reasons. First, AC has become a cheaper construction material as compared to red bricks. It is around 25% cheaper as compared to the red bricks. Second, AAC is a green product. It uses thermal power plants' waste product, that is fly ash, as an input material, thus taking that much carbon emission out of the environment which would otherwise need to be disposed. The company generates carbon credits to the tune of 65,000 units per annum. It is undertaking a capex post which it claims to be the biggest player in India in AAC. Once these enhanced capacities come into production, the management expects generation of carbon credits to increase from 65,000 units to 2.5 to 3 lakh units of carbon credits per year. So unlike Enking, which could be a very high risk reward play on carbon credits, for Bigbloc, carbon credits is an optionality play. Now please note that these are not stock recommendations, but only the names that I believe deserve to be on your watch list. So that's all for today. I'll share more as further developments unfold in the green energy space. Do subscribe to Equity Master YouTube channel for alerts for more such videos. And if you liked today's video, do press the like button and let me know through your feedback in the comment section. Thank you for watching. Goodbye.